So good afternoon and welcome to the first policy lab of our new Qatar Centre for Global Banking and Finance. I'm the Executive Dean of the King's Business School, Stephen Bark, and it's great to welcome you here today. And I've heard already from colleagues that you've had a fantastic day, very stimulating discussions, and what a day to choose to have your first policy lab. None of these discussions would have been possible without the support of the Qatar Central Bank. And it's been a fantastic experience working together over the last year to make a reality of our vision for the centre. We built an exceptionally talented team, and I'm delighted that David Aikman is here, the new director of the centre, and also Francesca Monti, our deputy director, as well. Both recently have come from the Bank of England. When we announced the support from Qatar Central Bank and our plans to create the centre less than a year ago, we were in an environment that was very, very different from the one that we find today. And clearly, we're all talking about coronavirus and COVID-19 and the concerns that we have about the economic as well as the health damage. And we've seen huge upheaval in the financial markets, the response of the budget today, and also the response of the Bank of England. And it seems that central banks' traditional monetary tools can only go so far in a response to this shock. And the use of fiscal policy has been called for by many in policy circles, as well as the central banking community. So following a decade of ultra-low interest rates, more and varied unconventional policies will probably need to be considered and developed. And I think, the upside is these are the perfect examples of the sorts of issues that the centre will address. And addressing these contemporary policy concerns underpins the creation of the centre. And I'm proud that it's a demonstration of how King's is making positive change globally by addressing industry and societal challenges. So part of the work of the centre will be to train and equip the current and future generation of international banking and finance leaders with research-led teaching of the highest quality to support financial stability and economic growth. We'll be starting soon with executive education programs for emerging specialists in Doha. And as many of you know already, we're developing a new executive MSc to focus on areas like monetary policy, prudential regulation, regulatory technology, and the use of new data sources alongside traditional financial forecasting techniques. So today, as I said, we've had very productive discussions, and it's the start of our research activities and discussions. Today, we focused on financial stability and Fintech, and in the summer, the Centre's first full conference will focus on new directions in central banking. We plan that this will be our formal launch, and we're looking forward to hosting the Governor of Qatar Central Bank, His Excellency Sheikh Abdullah bin Saud Al Thani, who was so instrumental in setting up the centre. And I look forward to seeing many of you there here in July. But first, to conclude today's programme, Dr. Francesca Monti, the Centre's Deputy Director, will introduce our eminent key speaker, Professor Iftekhar Hasan.
Thank you, Stephen. So I'll be brief because we want to hear Iftekhar speak. So I'm delighted to introduce to you Professor Iktekhar Hasan to conclude a fruitful and interesting day. So Iftekhar is professor at Fordham University and chair in finance at the Gabelli School of Business. He is co-director of the Center for Research in Contemporary Finance and is a research fellow at various prestigious institutions. He has been a visiting scholar for several policy institutions, including the IMF, the UN, the World Bank, the Atlanta Fed, and Banque de France. and is the managing editor of the Journal of Financial Stability. So a wealth of experience, both policy and, in academia. He has written extensively on topics of financial institutions, corporate finance, capital markets, as well as network and machine learning. And today, he will bring together the two topics we discussed today by addressing the highly relevant question of how fintech affects financial stability and the monetary transmission mechanism. So please join me in welcoming him. So you have 1 hour. Do you prefer taking questions along the way, or would you like to leave some time for questions?
I'm open
later?
to. People can stop me anytime.
Okay.
Yeah. Thank you
So
very
we'll do
much.
Like that. Thank you.
Well, it's a pleasure to be here. Thank you very much, Francesca, for your kind introduction. Thank you, Dean. Thank you, David, the organizers, the two Georges, and Alexia, and also Gulchin. Thank you very much. You guys have been a fantastic host. So I plan to speak today about two topics that has been the discussion today. One was in the early morning, it was more monetary policy and fintech related. In the afternoon, it was more about the fintech with regards to the AI and use of that. Now here, I'm not here humble and honest about this. I am neither a monetary policy person, neither an expert on fintech. But I am decided to share with you some of the things that I have been working on now and it's not a hedging. I'm going to be open to any criticism you can give on these papers. But I want to share with you certain aspect of things. And in this aspect, I'm going to share with you the issues related to the development of the fintech and AI. And my data and experience is coming from China. And you'll see that, based on the conversation we had this afternoon, you'll see that China is combined what China's fintech experience and the extent of fintech is higher than the entire world combined. Of all the fintech related, China alone is a higher amount of fintech. So you're talking about payment system, you can take the Alipay, or you can think about WeChat, you can do all the payments and so on. So in this aspect, I'm going to spend time with first share with you artificial intelligence. This particular paper is more about from a regulator perspective. I'm thinking about there is a tremendous amount of activity going on about artificial intelligence and fintech. And if you look at if you've been to the World Economic Forum, hundreds of different issues that talk about how AI has gone into different part of the financial industry. But as far as regulation is concerned, there are only some guidelines. And today, there's no specific requirements, only guidelines. And if you even go to the website of BIS, you find out some guidelines. There's no regulations at all. Now, your question would be that what I am trying to achieve with my two wonderful co-authors, one is a lawyer and a professor of law, and other is our PhD student. So here, we're simply trying to create a little attempt to see, can we bring something on this online marketplace lending industry, learn from how the technology is used and how the different players in this technology transfer are benefiting or hurting, and is something in evidence from the regulators or not. So I'll be grateful, Alexia, if you tell me 30 minutes gone, because I'm going to shift to the other topic. So here, what happened into this industry, the whole fintech came with the idea that there would be some sort of de-intermediation, in the sense that people would be coming in, the traditional banks wouldn't be there, but suddenly the industry has actually become more of a re-intermediation, because these platforms are now simply become asset manager. There are tremendous amount of money coming into them, and they are actually using this money to not only to the lending purposes about the choice of the individual lenders, they're also getting involved themselves with somebody else's money and involved in that. So in this particular case, there's some significant papers. All these papers are in significant journals. They're looking at how AI is used for screening borrowers, how to set prices. And here in this particular things, the next 20 minutes, I'm going to share with you how these platforms are using, with the help of AI, somebody else's money. Now, you could think about that, what is the theoretical underpinning for us to think about what are we thinking when we're thinking about this particular example, bringing and sharing with you. We're thinking about some theory papers, papers that are more in the capital market. People have written some papers in the capital market. People, Bolton and co-authors, they will talk about that there are players, there are informed players, uninformed players, asymmetric information. There's a high possibility the informed players would be able to take advantage from the uninformed players, and this sort of evidence. And people have shown some work with the high frequency data, how the high frequency data, it is one side of the high frequency data. You can do the price discovery, you can create a better market environment, but at the same time, you can see the informed traders sometimes can benefit from the expense of the information. And then we saw in the key papers of Rocher Tirol's in the both side of the market environment. But here the idea was more about the demand side of the price discovery. But the setting that I'll share with you is completely a little bit different than all of these things, because in the very beginning of the cream skimming of the game, I would like to show you that there's a possibility of totally taking advantage of one group of the others. And I will show you that how in the frequency trading, it is not a market price discovery, it's about a posted price. So if there is a supply side, I have a monopoly on the pricing issue. And on the demand side, on the both and supply and demand side, I'm not looking only on the elasticity marginal cost, I'm also able to show you the supply side pricing power. And also, there are some significant paper about the economics of these scope aspect of cross-subsidization. So if I am associated with investment banker who is also my investment banker, so I have better information compared to somebody who's not affiliated. If I'm a VC, I'm working one side with the bank, other side with the other customers. So this sort of papers also in the theory paper. And this evidence is going to give information on all of them. So what we do here, in general, we have some unique data. We go to the platform, and I'll share with you RenRenDai. It's one of the biggest platforms in China. And what we know about that we have all information variables that our platform has. And why did I go to China? Because this data is not available in the US. US has two significant platforms, all of them in the last 5 years significantly reducing information. Absolutely, you cannot get details about the lenders and so on and so forth. More importantly, you do not know what sort of trading taking place. Is it a human trade? It is an AI trade. But this particular case, we actually know the actual information. In each order level, I know exactly how the information taking place. Here, RenRenDai is a $1 trillion company now with hundreds of thousands of customers from both sides of different age and not only young people. So how does the funding works? The funding works simply, somebody comes in and say, I want to borrow $50,000 and these loan investors give a first bid, and people keep on coming bidding, and you will find out that when the bid is over, it is successful loan. So in my data, all loans are successful loans, and this bidding, usually you'll see from AI, 8 seconds it's a bidding. On general, humans do it within 1.5 minutes. So it's a very fast fintech environment of borrowing and lending. So here, these are scenario where it says a cash flow 10%. This is the way it shows up. Our entry page, you will see all the information. These are all 100% successful loan. And then you'll see different pages, 1, 2, 3, 4, 5. This is about loan. I will talk to you more. This would be about payment. There would be the other information about the lender, borrower. So he'll say borrower has a nickname. It has 104,000 yuan, 10%, 48 payments. Got a ranking from the grades from the platform. and 52 years old. This is the money he borrowed, makes $5,000 to $10,000 from Chengdu, works in a company for 10 years, 5 years, 10 employees as an undergraduate degree, and married. Why? All details are available, and actually, if you don't have a good job, the individuals go and certify it in the place exactly where the person is working, and there's a certification, and this is the way the lending taking place. And then you will find out all the different people are bidding, and each particular second, how many people are bidding, and by information, I know exactly one is human, one is AI. Yeah.
Are we able to observe the change in interest rates vis-a-vis those?
No, here the interest rate is posted. The interest rate is determined by the platform. So it is not something you can go and say, I have a different rate, I'm going for it. You just simply say, do you like this interest rate or not? Okay. So here, our attempt is to see, is this AI is used for strategic information provisioning? Is there a first trading allows them to do cherry picking? Is there a price manipulation? Is there a misalignment of interest? And these are the questions we're going to try to see with the data. So the platform wants to make money. They want to make money from both sides. From the borrower side, they take service fee. From the lender side, they take the management fee. So they have ability to take money from the both sides. And if this is something known to the outsider, and I will show you the information is known more to the platform than the customers. Customers would know that. They will know AA, A, and other ranking. But the platform has 246 different categories of risk level of the borrowers. They don't share that information with the others. As a borrower, you can only see these from outside, and these are the different charge ratio based on your riskiness. And our perspective is that you have a two-sided agent. In one side, you want to create more quantity from the borrowers because you'll make more money. And the other side, your asset management, you have to make more money in order to create a return to the people who are interested in you. So in some sense, you are the agent of the lenders, and you also agent of the borrowers. So we created, in our mind, there are maybe three kinds of loan: very best loan, second best loan, and worst loan. And the criteria is all there. It's absolutely best possible loan. And in this case, I have every intention to grab 100% of the loans. And then we sort of create that as the loans become worse, that time I don't have any incentive as a platform unless I want to make more fees. Here, I have some incentive. I want to make some fees, and I want to diversify my work portfolio. But as far as the bad loan is concerned, only thing I can do is fees. So we take 240,000 funded loans, and we know 24% is purely human funded, hybrid of 6%, and purely AI funded 70% of the loan over the time. And we look at, if you look at these credit grades, that the information that you know from everybody knows, you can see that pure AI has a better grades compared to what pure humans are bidding for, okay, information-wise. And you can see pure AI default is 0, okay, even though there is also a third-party backing. I'll come to it later on. So if you look at the funding time, pure AI funded is median 8 seconds, pure human 144 seconds, and hybrid is 5762. That means several hours of staying. So here we are creating. It's not that we are finding anything. We're observing it, and we are trying to see what is happening here. Is that in this particular case, that AI wait and facilitate strategy. They wait and see that you'll see. I'll show you exactly bit by bit. They put some money, attract other people to come in, and see more people to come in. And at the end, they really want to make this happen. They will make more fees. At the very end, even very bad loan, knowing that it's going to be trade-off wise, they're going to be making some lenders unhappy. They wait and facilitate the loans on the other end. And this way, they make more money from the bad loans. So here, you look at the information available. One is information, one of them is credit score, and other one is credit grade. Credit score is something that is more detailed, 246 items that the platform knows, and the other item platform only borrowers know. And if you look at the default ability, you can see that higher information on the platform is significantly higher. They have the better ability to get the default compared to the others, and credit score has a stronger explanatory power. And we show that in over the time, and we kind of show you some information on AUC with the ratio. And we said that in the beginning, when AI started this, they were almost indifferent. 50 is kind of indifferent between which side. Over the time, you can see that they are actually increasingly are choosing more of the cherry picking information available, and they are making the market completely different. Here we show that. So then we show you some estimation where our benchmark is again hybrid loan. You can see that credit score, credit grade, in both cases that both human and AI are significantly better than the hybrid, and we show that the default is less compared to hybrid. The time-wise is significantly less. And then we show some result between AI and human, and show AI is significantly a lower default, less time, and so on. So in some sense, we are trying to show you towards this experience is that the pure AI is choosing the best possible loans. And here you can see, I'm looking at this interest and premium, that even that it is, what happens is usually if you are the best possible loan, the interest rate should be lower, right? But given that criteria, still they're making a little bit extra premium because they have the ability to be a monopoly here a little bit, so they are taking advantage of that, and they are making higher interest rate and higher premium. So we go and check this is a little bit more with the hybrid loans in details. In hybrid loan, we simply see, are they creating cherry picking with diversification, or they are trying to wait and facilitate. And I show you how do I look at this thing in detail. Here, I look at a particular loan of 1,000 yuan, and I look at each of them, I divide them into 10 different groups. And you see in the beginning of the early stage of bid, they come very significantly in the beginning, and their bid goes down. In the later stage, they come with a little bit of bid, and they wait and wait and wait. At the very end, if there are other people coming in, they come with their bid. So in some sense, you can see that this is more about that wait and create a more loan strategy. And this is the way AI is making money in the other end of the spectrum. So I show this particular result to you with many different ways. I'm going to go a little bit fast. Forgive me for that. I will spend some time with questioning. Here, we look at simply to see how this ratio works. I show some pictures in this way. Then say within the hybrid group, you can see that they start from there in the early stage. All bid goes to higher credit grades. They do cherry picking and then diversify. And at the very end, they wait and facilitate. And even the loan is not as good loan, they make the market. So here you can find out that AI is giving them an opportunity so quickly to take within 8 seconds the best possible loan. And by the time the humans are coming in, they don't even have the right loans. And they have the higher, they take the loan that is not the best possible loan. And here AI is also creating more market for creating more fees for themselves. And we see this result through the within group differences in credit score. We see this in default rate. We see that in premium, and we say that interest rate. We find out in all possible cases the AI is coming and taking advantage. And there is a scope for them to take advantage of the situation. So in some sense, what are we contributing with with this finding from the platform. We are going back to the literature and say that in the cream skimming literature, we are trying to say that AIs have an informational advantage. It is not earned and manipulated through strategic information provisioning. So what the key theory papers have shown in the literature, we are showing the example from marketplace P2P lending to show that indeed higher information ability takes the one group to be taking advantage of the other. Then we go to the high trade frequency perspective. Here, there's no price discovery doesn't apply here. Price is fixed. It's a posted price. So here, the whole idea is who gets the bigger pie? AI does. They take advantage of the information of first trading, and they are taking advantage of getting the best possible distribution of the pie. And then we go into the two-sided market, and we simply say here that supply side has a pricing power, and so it's not only they're looking at demand elasticity, they are also capturing the rents from both sides, and we also show the evidence of cross-subsidy as shown by the premium and the interest rate. So why I'm giving you all this information to you, my main idea is there is no regulations at all. If this is the way the platform is working, in this particular case, regulator must figure out that information disclosure has to be proper. There should be credit score, not only credit grade, 246 different details should be given to everybody who is trading. We should know each bidder is a human bidder or AI. And one way to do this fast trading is not to allow each time to do trading. There should be batch trading, and some people are using that in the capital market. And this batch trading would allow them to really understand a little bit better about the timing issue. And if they really want to take some risk, they should have their own money. They should have a skin in the game, like the investment banks does in the IPO with the firm commitment. Here, they're simply doing the work with somebody else's money. So in this particular case, they should have a skin in the game. If not, they should simply create an asset management licensing where they have a responsibility. But currently, the platforms are working in such a way, both in the US, even though we don't have the data, but we are projecting that this is the way all the platforms are working. In the use of AI, the platform is taking advantage of the scenario in such a way that uninformed investors are not getting the right share of the pie. And without having some sort of regulation or framework on this particular issue, one party is getting better off, and we all should keep an eye to see how this P2P lending and AI's involvement can be different. So I will go and move into some different topic that share with you. I'm open to your decisions. You can keep your questions at the very end, or I can go both of them and then come back and ask questions. Is it okay? So here, it's different people. I do some work with two young people. They're in Germany. And while I was talking about this particular paper, and suddenly I found that there are information available these days in China about the amount of payment, actual payment done by Alipay, actual amount of fintech activities known. So then I went and said, okay, let's go and see whether we can get this data or not. So in this particular paper, I'll share with you that today when Mike was talking about, and later on I think George was bringing this issue in the topic, the person who was running the discussion in the fintech, HBC gentleman, he was talking about the question, is it a friends or foes? This AI component. So here you'll see the fintech coming in this particular case. If I have a policy issue, if I'm creating monetary policy issue, I think that was your question. Do you see that whether the transmission of monetary policy, is the traditional monetary policy going to work if this is the way the fintechs are? Is there a shadow banking coming in, creates an impact positively or negatively? Or if there's a digitalization taking place, payment system is changing totally, how is the effect of monetary policy? I am not totally done with the paper, but I'll show you some results we have on this particular topic. So idea here is that what is the impact of fintech on the transmission? That's the key questions. And I was thinking about this issue. Since my graduate school, when I remember Gartler papers on monetary policy transmission and small institutions and so on. After that, I have not done any other work on monetary policy. So I was extremely nervous coming in front of the economists, and I saw this morning the fantastic papers. But I was also a little bit confident because DSG model, they don't have as much financial friction. They have only one bank. And so on. So I was a little bit confident that, okay, I can share a little bit about. Huh?
That one financial friction is usually sufficient to get the dynamics in it.
That's it. I agree. I was teasing you, Yeah. So here, two things I talked about. One is this flexible pricing to borrowers and lenders, does it improve monetary policy transmission? Because there are some evidence that fintech creates applications so much faster, so much better. Some people at the Philadelphia Fed is showing that fintech is able to go, and I think one of our the person who was in the afternoon session, he was mentioning that one of the key reasons of this is to go into the unbanked individuals, and they show this evidence in U.S. And also it alleviates a lot of the discrimination. It's a debatable issue, and I will share some other issue to show even in platform, the loan rates are different. If you're a good lender, but if your neighborhood is bad, it's a Akerlof scenario, you get higher interest rate. But if you're a bad lender, but you live in bad borrower, but if you live in a good neighborhood, even the AI gives you a cheaper rate. But so these are the good side of the monetary policy side. And other side of the issue is that there are papers that says regulations account for 60% of shadow bank growth, but technology accounts for roughly 30%. So in this case, the regulatory arbitrage creates a shadow banking environment, and it can very much dampen the monetary policy. So we create this horse race and try to see whether there is a significant policy transmission, positive or negative. So here I also use Chinese data, and in this particular paper I don't go into the bank by bank because the data is differently. In bank by bank, I had to go through different paper I have to write because I can do the textual analysis and I find out exactly how much fintech they are involved and so on. Here I aggregate the data on the county level, prefecture level, and took to the province level. And so far, my results are going to be in the provincial level. And I'm going to go and create a regional level fintech development data with the subcategory. I'll share with you the category. And I will interact in a panel VAR. And it will give me, and I will create the impulse response function for here with random 500 bootstrapping. And I'll give you results of impulse function. And I try to see in respect of GDP, in respect of inflation, in respect of loans, and in respect of housing, how these shocks are taking place, and I will share the results with you. Here I have both price-based and quantity-based estimation, and I learned from the literature that people are using a lot this repo interest rate swap sort of thing, and that is coming for more in the price-based environment, and I take them into some of the total changes by quarter or year, because some of the data is not available quarterly. But more importantly, I have significant data, which I'll share with you more, is the quantity-based data, where I know the M growth, and we create the monetary policy shocks, is the difference between actual and endogenous M2 growth. So I give a shock with them on this aspect and try to see how things look like in the impulse response function. Here, if you look at both the IRS shocks and the M2, the price and quantity, you can see that their correlation coefficient is minus 25. It's understandable. It should be in opposite direction. One is expansionary, and so the other side. And interestingly, you can see that they're converging as the time is coming in recent years. And we can make some comments, something to learn why it is happening. But here, the data-wise, we look at, get some data from digital finance. And these folks have sources of data is for me is from Ant Financial. I don't know you know the Ant Financial or not. It's the second largest fintech company in the world. Market value is the number 2 as a tech company. And we also get the data from the Alipay, which is the largest payment platform. And this data, we look at two different ways. The coverage is not a good data in the sense I'll share with you. Coverage simply gives you number of people member. But here on the usage, we can know the amount of money are spent on the internet financial services, online payment services that we're talking about this afternoon, how much is purchased on the monetary fund, how much I have invested my money through the internet. So there we create an environment where we have the online purchasing on, we call it financial usage. Whereas in digitization is a penetration of mobile payments and QR code payments. Here, every payment that has been done, either by the mobile payment or by WeChat or Alipay, or with the code, we have the amount of each of these activities. We aggregate them in the regional level, and we create that and look at the results. So if you look at here, depth of usage is the use of money fund, individual user, investment, credit investigation. Level of digitalization is mobile payments of all sorts of mobile payments, credit, convenience, affordability together. And we have data for 31 provinces in China. And I am going to share only the provincial information for you. I don't have the output variable details yet at the county level. So it was easy for me to share only the province level data for now. You can see the fintech. You can see that it has increased almost 9 times over the last 2011 to 18. And if you look at here, these are understandable. Shanghai, Beijing, Zhejiang is a very entrepreneurial city in China, close to Shanghai province. Guangdong is a business province, and Tianjin also is a business and specialized trade zone area. So these are understandable. These are more used. But you can see usually the provinces that are on the northwest, Guangzhou and Shanghai, these are autonomous regions. They are not as developed, so the use is not as much there. But still, if you look at, it has increased quite a bit, all right, in the sense that here you can see many of the areas are increasingly getting to changes. There are a lot of changes here, more importantly for us. So when it comes to Henan province, and they have moved from change from here to Henan. So I have seen that a lot of changes are also taking place in our data, that use is not necessarily same across this. There's a change of ranking. And we talk about some of these, Heilongjiang and Liunan, these are here, that they are actually moved backward compared to some of them went in the forward from quartile 1 to quartile 2. So there's some variability in the data. And look at GDP growth, inflation, loan growth rate, and housing price. And later on, we create some additional interactions with GDP per capita and liberalization index to show you some more results. It's interactive panel VAR, and it's alternative to the stochastic time varying coefficient VARs in a single country model. I have seen some paper that people are looking at this from capital flows and housing booms in European Economic Association paper. And I have seen also a paper this on foreign currency debt. So we're using that here, similar method they have used. And this is something no need to show that. So the baseline estimation is to look at the dynamics of these 5 variables. And we are looking at this instrument shock. And so what do? We consider first the fintech usage and digitalization and try to see how results show up. So if you see here, there's no fintech interactions at all, normal. So as you know that this is my impulse response function. I created a band, 90% band, and those of you are like me knew about this issue, that this band, the moment it goes to 0, that means that it is not really significantly different from 0. So in the sense, and broader is the band, less it is working. So in some sense, you can see without any fintech or so on, there is a shock of monetary policy expansion. There is some increase towards fintech. CPI is increasing. There's a little bit increase in the loan amount. There's nothing to say too much about housing. But when I look at these things between low usage of fintech, high usage of fintech, you can see in a lower fintech environment, the results are significantly better working than in a very high fintech environment. So in some sense, we're not finding results in the very high tech, high expansionary policy is not as much in we find that different impulse response function and sign. So here, if you look at the fintech dampens the monetary policy to macro financial market when it is too much usage of above average. So in this particular example, we are finding, contrary to our expectation before, because we did not have any idea what we will find. So here seemed like the regulatory arbitrage environment, this use of internet, I'm doing my investment, I'm doing my payment, taking my loan, all are not through the banks. I'm using internet to other areas. So these are an increase of the shadow banking environment, and that is creating actually a dampening effect on the monetary policy. So here you can see that in the expansionary shock, real GDP increased after second quarter in the lower fintech environment, but in higher fintech environment, we find it is actually dampening the monetary policy wise. You can see it is not really something significant. So we sort of talk about that this is creating. Then we go and look at the information with digitalization and look at the overall no fintech interactions, low-level fintech interactions, high-level fintech interactions, and then we take each of the provinces and interact with the province level and look at the impulse response function. And we see that in this particular case, the results are significantly more robust when it is a high digitalization area. Digitalization is simply price and convenience and speed of payments, and we find that it is actually higher fintech environment, digitalization environment, that the monetary policy is working stronger than it is in a low fintech environment. So in some sense, that we are trying to think about that higher fintech digitalizations improving the pricing efficiency, and we are seeing a better monetary policy transmission. And do we know all the story, everything properly? We are not sure. We are interacting this with the market, the fans marketization variable. We're interacting this with other GDP per capita. Results are relatively consistent between these two, usage and digitalization. And so in some sense, given that what we have so far, and I think I shared with you that I don't have the completeness of this particular paper. So far the evidence we are finding that when it comes to usage of debt, that the usage of debt in the sense internet payment is more through, not through the banks, but they are doing businesses, all sorts of payments through internet. In that sort of environment, the monetary policy shock is not doing as well as the transmission, but where the area they are improving the efficiency of transmission, it comes with the mobile payment and the convenience of transaction. We did not even look into the details to see are this area where there are higher usage and but higher digitalization, higher lower usage, higher digitization. I was actually looking at last couple of days, so I don't even have those results to share because more things to see, because these are the first batch of estimation. But now I think we can really go and see how things are. And this is actually the main results I have so far. So in some sense, it's a mixed result. In some area where there's a shadow banking is dominating, monetary policy is not as effective. Where the payment system speed is stronger, monetary policy is more effective. And this is exactly the two of the topics we have talked about today. And instead of bringing the thing from the theory and the model aspect, I shared with you simply some data that I have come across and to see how data is talking about these particular questions we have in academia. And I shared with you some evidence we have. I'm opening up for any questions you have on both issues. Thank you very much.
Sorry, Iftekhar, are you able to observe what these two do to interest rate or the sections of the society that you are reaching? So in terms of your differentiation, I wouldn't necessarily expect a huge impact if it's just the speed. So you could have access to this lending, whether it's in a month's time or 3 months' time is not really that consequential. What matters is whether in equilibrium exposed that leads to lower interest rate, which would mean that obviously you would have greater impact. Or maybe you are allowing a bigger sections of your society to benefit from extension.
Yes, I think very good question. I will look into it, but I want to share with you that it's not that straightforward in China. In China, the interest rate, if you think about equivalent to our Fed fund rate, is not equal everywhere. They actually, if the bank is located in certain area, which is below certain amount of poverty, below certain amount of population, the rates is lower. And
that's where you get.
yeah, so exactly. So that's why I need to go, because the data that we have the way it is, the prefecture level data, I could not match the CPI and the GDP I did, the housing, so I'm matching those. So I only took the state level so far because I got the data quickly to match them. So in order to go to that level, we plan to do that. We don't have the actual matching of the data yet.
Fascinating stuff. One question I had, I couldn't remember what you said about how you're identifying the monetary policy shocks here, and whether these were changes in reserve requirements or interest rates. Could you just remind me?
So here I think that in this particular case, we just simply gave that they give a shock to increase the money supply. Yeah. And so that's the way we shown result. But we have also some results with the pricing side, contractionary. But I think that to be candid 100%, the result is more consistent with the expansionary side. So I shared with you. The other one, result is similar, but the results are not striking. So kind of thought that let's do more work, more detail, and then when I really finish the paper, we'll, good or bad, we'll put all the results together. Yes. Nathan.
If I can reframe your conclusions. So you showed, I think it's very consistent with what we think about monetary policy. So monetary policy is more effective, short-term monetary policy, when you have a lot of frictions in the economy, confidence and friction. So on the one hand, the fintech is actually, this financial deepening and inclusion is something that reduces frictions in the economy because it creates more markets and so forth. And maybe it's correlated with other things that are happening in the province that are also, these are less friction in those economies on other dimensions. I mean, maybe correlated with something else. Whereas the other finding is that for a given level of friction, the more digitization you have, the more efficient are the pipelines, then the monetary policy is more effective. So these things are, I think, are consistent with our theories, and what it suggests that fintech, in the financial inclusion aspect of it, financial deepening, I mean, that's something that we have to actually, looking forward into the role of monetary policy and transmission mechanisms and so forth, is something that we have to think about more carefully in terms of that you're actually reducing frictions in the economy. And so by construction, you're making monetary policy according to standard.
Yeah, I totally agree. I'm not a Chinese speaker or reader, so sometimes it's a lag period by the time translation comes in. But the good news about this one is the data, the whole data initiative is based on that how much inclusiveness. So the data was not produced for my research question. The data is actually produced exactly what you said. They want to see how much of inclusiveness is taking place, whether unbanked are coming into the system or not, and whether the poverty is changing or not. That's their mind. So then I kind of thought about that the segment of data I showed you, this is only for our purposes here. Now I'm finding that they have some more detailed information about this inclusiveness. So if someone, not me or anybody, wants to do some work on this area, this data can be used for that purposes to see what kind of inclusiveness is creating the speed where, how much. And I think going back to Gulchen's point of view would be, to me, it's also fascinating to create all the prefecture which are like a rich neighborhood, right? In the sense MPC could be completely different, right? MPC could be completely different in another neighborhood. So we can even look at some basic economic understanding to see how the policy speed is different from the neighborhood they are in, and we have the possibility to see that. I haven't seen it yet. Yes, sir.
Sort of a similar question. In both papers, you have very interesting results in terms of how AI is impacting, how Fintech is impacting. And I think in the second paper, the discussion reveals sort of an understanding of what is the channel through which this is taking place. In the first paper, similarly, what is the channel of the AI having the strategic advantage? If I have understood your result correctly, they were having a strategic advantage. What is the channel of that happening? How are they able to have it, use it, prolong it?
What happens is that, yes, thank you for asking this because I did not explain this. So this trade taking place, unlike in the capital market, where individuals coming with AI and working, is not that yet in the P2P market. P2P market, the platforms have the monopoly. So 3 big platforms. So they take money from all the lenders, and they decide that these loans are available for borrowers, and actually they are using the AI. So they're quickly taking over the market and leaving, and they themselves, you can deeply criticize this paper by saying only one thing, that the marketplace has a monopoly. If it is not AI, it could be GI, MI, I'm just making up something. They can make the money because they have the monopoly. So in that aspect is a weakness of the paper, that it is not about AI. Anything else, these people have total monopoly, they can make the money. What we trying to capture from the AI perspective, that, hey, look, AI has an advantage in this sort of environment. So regulators should think through this issue a little bit more early on, because AI can create an advantage for traders that people have shown in the capital market. In a high-speed environment, other environment, information can go, but we are seeing this also evidence in the P2P market. So the contribution is simply to awareness for the regulators to think about. There is a negative externality also comes from AI. That's all we tried to say in that paper.
So similar to some things that we talk about in the old markets, where market makers have more information. They know,
yes.
They know the trading book. They know
yes.
the bids and ask, and how that can be controlled either through regulation or through certain other means. That's the question.
Exactly.
Proposing.
Yeah, in the P2P market environment. Yeah.
There is this advantage that they have, and somehow that should be managed.
Yes.
Managed is not the right word, but
yeah, exactly. Exchanges already taken steps to manage that as much as, unless it's a fraudulent activity. But otherwise, the exchange is taken in the microstructure environment. They've taken steps to regulate that. But in the P2P environment, it's not taking place, and trillions of yuan is trading there, and it is trading hundreds of millions trading in the US. And we need to know more information, and they're not under regulations of the Fed. And so these sort of questions are simply to aware how should we proceed. So only positive side of the paper in my mind, that we have some information that is not available in the US, and this gives us ability to see a little bit more. That's it. It's not pathfinding something completely new. So actually, I want to share with you that if anybody is interested in this, so this P2P lending data, this Akerlof's, Akerlof has a paper with Krant, is about identity. People tend to, yesterday Nathan and I were talking about this issue on the whole evening. So people tend to think who I am, I'm good. My friend is David. So David likes playing chess. I like to play chess, even though Gulchin is my professor friend, but she likes, soccer. But so I identify more with David, and in my economic transaction, I give him a cheaper loan. So in China, in this data set, we find it's a very diverse country, even though we don't think about. If anybody Chinese here, they will talk about if somebody from the north, they will say, oh, those northern people, don't believe them. They are cliquey. And the northern people will say, oh, the southern people in China, they will talk a lot, don't trust them. And this continues. So here we actually go and try to see when the trading takes place, we know the hometown and details of the lender and the borrowers. And there they're making their decision within 60 seconds. And how do the pricing, how do they choose? And it is excellent perspective. And we also have some excellent instrument that people who come from rice region, they are more friendly people because in order to have the water coming in, it has to come from other people's land. But if you're a wheat farmer, you don't need anybody's help. Rain depends. And Science magazine had this article on making 200 Starbucks to keep tables one chair or many chairs and see what people come in sitting. And then they ask, where are you born? And they find it is true. The people who are sitting in the many chairs, they come from rice region. And people who are coming and sitting from wheat region. So we use that as an instrument. We find that there is no hometown, even though hometown is a significant issue in China, but we did not find that. What we found, social capital mattered. And social capital is a combination of how much blood donations people do in that particular province, how much NGOs they have locally grown, or the managers of 15,000 CEOs where they think they want to do the best possible business. So we created that, and we find that social capital is significantly influencing people. So if you're from China, they will know that there are some areas. They will say, oh, you're going to that province? Keep your wallet in the front, okay? And in unbelievable amount of stereotype exists, and especially from the Shanghai point of view, big city point of view. And people are trading, and so that aspect, what we found, Akerlof sort of scenario, that if somebody is a bad borrower but lives in the high social capital area, they're benefiting from it. And if somebody is a good borrower but not staying in the good neighborhood, they are not benefiting. And I personally like that paper. Maybe it's not as much a finance paper, but I'm interested about pushing this issue more. And I also thinking about this monetary policy aspect. My reading tells me that if I can quantify the individual bank's usage of monetary policy, then my estimations would be better. So I would know exactly the players who are involved. So here we do not know. Then only way to know is to go do this annual report, do some textual analysis, try to see how many times they're talking about fintech, how many times and so on, creating something. And then you took a look at the risk-taking behavior. This way, this sort of paper is more in the mainstream monetary policy and risk-taking behavior of banks. I have seen many papers in this area. I appreciate you staying so late to be with me. I thank again the school, the King's School of Business, King's College, the Dean, Qatar Foundation for giving me the privilege to come and share some of my work. And I also get to know you guys a little bit more, and my good colleague and my big professor in my school, Gabelli School of Business that I'm from. Professor Chatterjee is the Gabelli Professor of Finance. He is actually visiting London on a school matter, so I'm very grateful that. Yeah, you came and listened to me. I thank you very much. Yeah, thank you.